Mint is still $15 a month for premium wireless. And if you haven't made the switch yet, here are 15 reasons why you should. 1, it's $15 a month. 2, seriously, it's $15 a month. 3, no big contracts. 4, I use it. 5, my mom uses it. Are you playing me off? That's what's happening, right? Okay, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan. $15 per month equivalent required. New customer offer first 3 months only. Then full price plan options available. Taxes and fees extra. See mintmobile.com.
Reality radio for a really great future. We're talking real money.
Well, we're supposed to be the big brain species on the planet, so you'd think we'd remember stuff longer than we do, but we have a horrible tendency to look back at the very recent past and extrapolate that out into the future. It has a name. It has a name. Hi, everybody. I'm Don. That's Tom. Welcome to the Talking Real Money podcast. And its name is recency bias. You get caught up in what you think is going on when it in fact has been going on, and then you adjust things based on the recent past. And we're seeing that play out in our investment portfolios and retirement plans with an emphasis, a higher level of emphasis in our portfolios on what's done well over the past decade or so. Stocks. Yeah, more stocks in our portfolios than in a very long time.
Yeah, and I get it. First of all, I don't want this to come off wrong. I would still, for most people, suggest you have more in stocks than in bonds. Most people, not everybody.
Right, that's generalizing.
That's general.
And there should be an asset allocation that kind of follows based on your risk tolerance, your age, those kinds of things. And it's a glide path. It's a step down.
Yeah. And by the way, we have a free risk quiz you can take by going to talkingrealmoney.com, clicking on the risk quiz to help you understand yourself about your emotions and money. But I get very worried when I read things like this from the Wall Street Journal. Workers across nearly all age groups are investing record portions of their 401k accounts in equities. That's another fancy word for stocks. After years of relentless market gains, they're either allocating more to stocks or having done it for them by money managers. Let me give you a couple of numbers. And this one doesn't worry me as much. Workers in their late 30s had 88% of their 401ks in stocks last year. That's basically 9 out of $10.
That number makes sense. You should have a high stock allocation when you're young.
But the point of the article was it was 82% a decade ago. These numbers from Vanguard, which examines the average stock allocations of the millions of people in the plans it administers. Here's another one that I worry more about, because in your 30s, 40s, yes, you should have a lot in stocks, maybe a little bit in bonds to sort of cushion things. But when you get older and you're getting closer to using the money, you should probably have more in bonds because they're more stable generally. So here's the part. So 401k investors in their early 60s had allocations of stocks of 60%. That's up from 57% a decade ago. Still, that doesn't sound dramatic. But it is, like 5% more.
It's a creep. And here's the problem with it. You're doing it for the wrong reasons. You're not doing it because your risk tolerance or your risk profile has changed. You're doing it because of past performance. That's the reason it's being done. I mean, that same article pointed out that target date funds are increasing their allocation in stocks. Now, why are they doing that?
Well, they're like you. They're chasing performance. By the way,
like me, not me.
Well, I'm talking about you in the audience.
Right at me.
Jason Kephart, an analyst at Morningstar, said, and I love this quote: "It's easy to have a higher tolerance for risk when the market does really well. If we just had a 10-year bear market, I don't know if you'd see a lot of people increasing their equity exposure, even though when stocks are down, that's exactly what people should be doing." By the way, risk is higher now. It feels safer, but it's higher because stocks have gone up. Yes, target date funds and the people who run them should be ashamed of themselves for the fact that they have increased their allocation to stocks. For investors 5 years from retirement, the average share of their target date funds in stocks was 55% in June versus 50% in 2020. That's dramatic. And 40% a decade ago. Let me give that to you again. So it's gone up to 55% in stocks, 45% in bonds for people that are getting close to retirement. The people that ran these things a decade ago said, well, we should have about 40% in stocks, 60% in bonds. That is a crazy change of which should be examined very closely for those of you in those kind of funds to make sure, again, that it matches up with what you're trying to do.
It's not like anything fundamentally changed in the investment world or in the world at large. Nothing fundamentally changed that should have led to a higher equity allocation in the portfolio, except there's only one thing to which I can attribute managers' move to greater percentages of equities, and that's because you basically ask them to.
Yeah, and I get worried when I read quotes like the one from Jason White here said, I was pretty much of a 60-40 guy. That's somebody who has 60% of their money in stocks, 40% in bonds, until 5 or 6 years ago. It just wasn't working anymore. So now he keeps 90% of his self-directed equity investments in the equity market, including his IRAs. His 401k is invested in a target date fund. Frankly, the target date thing probably out of all this worries me the most because people are trusting someone else to do this for them. And these companies, and it says including T. Rowe Price and Nuveen, have adopted higher equity allocations in their target date funds in recent years. They do not quote the companies on here for saying why they're doing that, but I think you're right.
Pandering. It's all pandering. They're just giving their instead of giving the investors what they need, which is a massively well-diversified portfolio. By the way, let me just add this. I don't think that article mentioned it, but I'd be willing to bet that not only have investors' equity allocations increased, but also the amount they have in the U.S. market has increased.
And tech.
Technology, but
yes,
the amount that
of course.
they have a much larger amount of money in the U.S. market than they did before. And it's curious. I was just looking at some numbers post-2008. After 2008, for about 5 years after 2008, equity allocations declined.
People put more into bonds.
They put more into bonds.
When they should have been buying stocks, of course, because they had gotten beaten up 2007 through 2009.
I'm not saying become a contrarian and do whatever I'm saying have a stupid plan and quit
I was going to get
playing.
to that. Yeah, right. I agree.
Just this kind of stuff just infuriates me because I know most of you are smarter than that.
You indeed are, but you get caught
Look at
up.
your portfolio and tell me if you've increased your equities. Tell me if you've increased your U.S. allocation. And if you have, you're not listening.
But most people that end up that way, it's not because they're not listening. It's because they're not doing anything. In other words, they may have started with the right allocation, but they may be putting money in, and that money's getting invested in more in stocks, whether it's target date or on their own, or they have a total market fund, and guess what that's moving more money into? Well, large U.S. companies, because they've done well. They're sucking up more of the money.
What you're saying is they're not rebalancing.
Thank you. And this is something most people do not do. I think you and I have discussed this. I check my portfolio. Now, I've got others watching it, but I only check it twice a year. I think if you're doing it yourself, to have it looked at twice a year for rebalancing opportunities is a great plenty. I mean, I think you could take from the rich, give to the poor, but make sure you're properly allocated. Most people are not. Most people are too U.S.-centric. Most people don't have small value stocks that they should. Most people don't have very much emerging markets, which has been not of late a great place to be, but in the long haul, a very good place to be. But where are you on the how often to look at your money situation?
Well, I don't know if it's a matter of, I look once in a while, but I don't really drill down. It's just like I go to Schwab and say, oh, okay, yeah, I still have money there. But to reallocate, to rebalance, generally speaking, unless there's a major market move one way or another, I don't do it any more often than annually because I've got other things to do. And generally, it hasn't made that much difference if I do it more than annually because there haven't been, with the caveat being when there's a big swing.
And we had
like the
a
COVID
little bit of
market,
that in April.
or the April
quick.
thing. Yeah.
It was down quick, and it was up relatively quick. But
And I think I did make a little move when there was a big move in equities then, but that was it.
And this gets back to what you mentioned, that, again, most people sort of invest in things. They hear this was a good thing. They move the money to that rather than having the plan, rather than, as we mentioned, taking the risk quiz, for example, building a plan that says, here's what I'm trying to achieve. I'd like to make 7 or 8% a year. And as a result of that, I'm willing to see my portfolio go down by 25% at some point, which hasn't done a lot lately. Almost, it got close this spring. But this is part of the reason that you mentioned recency bias. People have a tendency to think, well, it just keeps going up until it doesn't.
It's going to go down. Yeah, it works. Everything works until it doesn't. Investing in stocks works until it doesn't. Investing in bonds was great until it wasn't for a little while. And now we've taken that little while that bonds performed badly, which, by the way, should have been expected, because what drove bond prices higher over the many years that they rose was falling interest rates. Well, they can't. It's really hard to get interest rates below zero. It's not impossible, but it rarely happens. So you can figure eventually the piper needs to be paid. Bonds are not supposed to go up or down a lot. So if they go up a lot for a long period of time, then they need to go down to revert to the mean. But generally speaking, having a little bit of everything is better than focusing.
Yeah, it's boring, but it's worked over the long haul. So, yeah, again, going back, checking, first of all, knowing what you're trying to do, making sure your assets line up with that, looking at it from time to time, because people sometimes set things up and then they forget. And again, I'd use the risk quiz to help understand. But then here's another one to think about, Don. What do you think about this? Because if target date funds are now going to start messing around with their asset allocation, because we just basically trusted them blindly, like, okay, I'm retiring in 10 years. Some guy just brought up the 2060 target date fund. I said, what, people are still going to be working in 2060? Wow. At any rate.
I'd be 104.
I don't even want to think about it. So what do you think about if you have a target date fund, take that ticker, go to Morningstar.com and type it in just to see. It's very simple, by the way. You just click on portfolio. It'll show you your stock to bond ratio. Make sure that fits with what you believe your stock to bond ratio should be, rather than, as we've done for decades now, blindly accepting what those asset managers, and especially in the actively managed ones like T. Rowe and Nuveen, are doing, because it's probably something you need to understand, especially if you're in your 60s and moving closer to retirement. That's a time to really know what your asset allocation is, correct?
Yeah. And it's something you should probably look at every year, like I said. But here's something really interesting. If you look at the companies you mentioned who changed their target date allocation, both of those are actively managed mutual fund companies.
And they're going to be expensive.
Vanguard's allocation doesn't change in their index target date funds. So they're not going to pander. They're going to maintain their allocation, and they have for as long as these funds have been around. So it's curious that, again, it just shows that active managers think they're smarter than the market.
Yeah. And you're going to pay them more for being
and
smarter.
You pay them more. And they're really, there's no evidence that they've ever been or will be smarter than the markets.
I think Vanguard's lowest stock to bond ratio is 50-50 too. Didn't we look into that for the target date fund? The one that's once you get retired, I think they stabilize at about half in stocks, half in bonds. So there's not a lot of movement after that.
They actually continue to glide path.
Oh, they do. Okay.
7 years after, it appears they get to a 70-30. 7 years after the target
30%
date.
in
30-70.
30 in stocks, 70 in bonds. Okay. So
that's what
very
I'm
conservative. Very
conservative.
All right. Let's take a look at a couple questions. We're still getting a lot at talkingrealmoney.com.
Are you really? Are you really? Because I think
I'm
you're being a
getting
little stingy with the question.
Well, I might have my selfish reasons for holding on to a few, but yeah.
Okay. All right. I want to get all the questions. I mean, I don't want you to have last time we spoke, you said you had about 30 of them in a pile.
I think I still think I have 24, but Roxy took a bunch. We're going to do a show with her, and then I figure I'll have a few on my Saturday show. So we're starting to whittle away at them. So, but keep them coming.
I only keep about 4 or 5 of the spoken ones.
Well, you know,
reserve.
I'm a hoarder.
You're a conservative.
At heart, so
yeah.
Randall writes us from Jackson, Missouri.
Missouri
Jackson,
or Mississippi?
M.O., isn't that
M.O.,
Missouri?
that's Missouri. Okay, just want to make sure you didn't see M.I. and think that was, or M.S.
Which
MS.
could happen, by the way.
M.I.'s Michigan.
I discovered your show several months ago and truly enjoy listening. We do apparently have one difference of opinion, though. All right, this is careful. You probably have to write this down a little bit because there's a lot of numbers here.
All right, hold on. I got to find some paper. Okay, go ahead.
$2,200 monthly to fill in a desired $8,300. So I'm not sure if that means he has income.
Okay, so he needs
else.
an $8,300 monthly income. It sounds like.
No, he says he needs $2,200 monthly to fill in a desired $8,300. I'm not. Again,
well, he's looking for an additional $2,200 to fill in the 83.
Yeah. So he purchased a fixed income annuity with a lifetime joint payment rider of $2,208. Then he says that's $46,496 a year.
Okay. And
that doesn't sound right to me. If you take 2,200 times 12, that's not 46,000.
Did you have a calculator?
No, I don't need to because I can do 12 times 20 and know that's closer to 30,000 instead of 46.
That's 26.
Okay, well, even less. So, okay, but let's just keep going through this. He made a one-time payment of $320,000.
Okay, $320K.
Yeah. And then he says, leaving me with $350,000 in the market and $325,000 in fixed income. Okay, now I'm starting to get a bit earned. So maybe he has around $1 million. And
yes, that does add up to about $1 million.
That adds up about $1 million. Okay.
Did you want a calculator for that?
No. He says, I'm 69, wife 64, zero debt, average monthly expenses of $3,800. That's why I don't understand the $8,300 earlier. But
average expenses of how much?
$3,800 a month.
$3,800.
So 4 times, so $50K a year.
So okay.
So there's a lot of numbers here. It's confusing, but the annual payment is 8.25 of the lump sum and fits in my overall plan. His question, his argument, his debate, I guess, is over buying this fixed income annuity with the joint payment rider.
Okay. Which means that it'll pay them.
So explain what that is first.
It'll pay them both for the rest of their right. So if
you're giving them $300,000, they're giving you $26,000 a year.
Right, they're giving you $26,000 a year back for your $300,000.
Yep. Right. For both of your lives.
For both of your lives.
Yep.
And here's the trade-off: the insurance company has better calculators than you do. They are, my new term, I love this.
Yeah.
They're the wizards of odds.
That's right, the wizards of odds.
The wizards of odds. They know that they are likely to make a lot more money than they are paying you. Because bear in mind, at how much did he give him? Was it exactly 3? No, 320, you said. Is that right?
Let's see. Yes, made a one-time payment of $320,000. Put that into AI.
Okay,
see what
so
they think of
that's
that.
12 years. 12 years
of
if they made no money and they paid you no interest. If you took your $320,000 and just took out your 26 and change a year, it's going to last you for 12 years.
Right.
So they have figured that, and he was how old?
69. His wife is 62.
70. So you have to live, sir, past your average life expectancy. Your wife might just do that, but they're betting you're going to die earlier, and they get to keep whatever's left, whatever they haven't paid you.
Well, and
bear in mind, they're making money along the way on the money.
They've invested that money, so it's not just sitting in a bank somewhere.
Yeah, let me. In fact, let me ask.
So this is because I think people misunderstand how we feel about annuities. I don't like the product for a lot of reasons, for the tie-up, for the cost, for the commission. which suggests that, there's a reason they pay a big commission out on these things because they got to find people to sell them instead of you just looking at home saying I got to buy it. So it doesn't mean we hate them. I just don't think that's the best way to do it. You could take the money yourself, invest it, and create your own, annuity, pension, whatever it is, or even hire an advisor to do that for less and still be 100% liquid, et cetera, et cetera. And if you die prematurely, you get the money. All the things, those are the reasons we don't like them. But it doesn't mean if it's for you and you say, this is really what I want, it's not going to mess with anything. And plus, he said he has another 600 or so in stocks and in bonds. So,
and it's not like, we have said over and over again when people say, well, you hate annuities. No, we don't hate annuities. We hate indexed annuities because of the way they're sold.
Absolutely.
We hate variable annuities because of their high expenses. But we don't hate immediate annuities. We just want you to understand them better. That's all. Because immediate annuities they do serve a purpose like yours. They give you some certainty for the rest of your life. That's not a terrible thing.
No. So, again, for you, it might fit, but you need to understand those trade-offs, Randall. But it sounds like you already made the move anyway. So that's what he's saying. You and I have an argument. I'm not sure we have a big argument, though, because, again, if this is something for your security, then go right ahead and do it. Just understand the difference.
I ran the numbers on $320,000. If you just made 5% a year, which would be a bond ladder or a CD ladder, you could sustain those $2,200 payments.
For how long?
For almost 20 years.
Yeah. There you go.
So until you're almost 90 years old.
With
and
very, very, very little risk.
Yeah, what if...
And the 100% liquidity. And anything bad happens, you can get the money, and if you die prematurely, you still get the money. All those things that...
But what if we went to 6%? I want to see what that number would be. If you just, went from fixed income to throwing in a tiny, teeny bit of equities.
6%.
Now it lasts...
Reasonable. How long?
23 years.
Yeah. So you get the point. Your wife's 85. So there you go. All right. Next question. Richard from Salem, Oregon writes, you mentioned that the caller can change the beneficiary of the 529 and then contribute it to a Roth. According to the rules, the 529 must have been open for 15 years for the designated beneficiary. Additionally, the funds must be rolled over, have been in a 529 account for 5 years. In other words, you can't just put it in 529, move it to a Roth. Makes sense.
No, you have to. You have both the 15-year waiting period on the initial. But that's like, if you've got a little kid and you put money into their 529 plan, and then they get to college age and they decide they're not going to college, and you don't want to leave them the money anymore. Well, you can move it to another kid, but then you still have the 5-year hold. That before it can be moved into a Roth.
Which to me that's not a big deal. The rollover amount is limited to the annual Roth contribution limit, which is $7,000 in 2025. I think people do forget that. They read the $35,000. I just moved 35. No, you've got to do it. He does also mention lifetime limit of $35,000 per beneficiary. The 529 beneficiary must also be the owner of the Roth IRA, and they must have earned income at least equal to the rollover amount. Sure, it's just like regular Roth rules.
So basically what he's doing is he's just sort of filling in the details.
Well, he's saying, so my understanding is you cannot name a new beneficiary and transfer to a Roth without waiting 15 years.
You have to wait 15. Yes, you have to wait
from the time you
set it up for the kid. 15 years. Yes, that is correct.
Yeah. Thank you for that clarification. I still think it's a pretty good deal, though. Joseph, I think 529s are way underrated now due to the fact that you could just hold out the $35,000, put it in your kid's Roth IRA for how many years? Is that 5 years, whatever it is, and plop that in there for a long period of time. Joseph writes us from Eatonville, Washington. Hi, guys, new to the show. Wish I'd found it years ago. Me too, by the way, as I never paid attention enough. Thanks for all you do. Our portfolios are combined $980,000, and I've gotten an average return of 7.5% investing on my own through exchange-traded funds, mutual funds. Is it a good idea to hire an advisor if they only offer an 8% return while charging 1% of AUM? That's assets under management. Maybe I get good value for having them in my corner. It's 59, retiring by 62, have pensions. Money-wise should be fine. pay
I would never
somebody
hire an advisor who promised me a return.
Thank you. That was the first thing. Like, well, first of all, you called somebody up and they said, "I'll get you 8%."
I'll get you 8%.
Nobody,
no, they don't
nobody
know
knows that.
Nobody
they can't
knows
make
that. Now, if you're just making for comparative purposes, you're saying, okay, the advisor might make me 8, and I'm making 7.5. Is it worth paying the fee? Yeah. Is it worth paying the fee when I'm only making half a percentage point more?
And if it's just about asset allocation, no.
Right.
But it should be way more. A good advisor does many things outside of just
That's what I was going to say, because
portfolio.
it's not just about the return of the portfolio. It's about how much are you going to pay in taxes when you take that money out of the portfolio. Where are your income streams? From what part of your portfolio is your income stream going to be generated initially? What's the best place to take it? How do you avoid taxation? How do you best leave assets to your heirs? And all of these things that come up when your portfolio gets to be, about $980,000.
$1 million. There's a lot of things to consider. You're right in that prime area, if you will, between, kind of the end of working and starting to draw the money out. A good advisor, we've talked about this on the show. I think you had somebody on from Vanguard to talk about it. I mean, really should make you way more than the 1%. No promise, but should.
No. But over all of the people who invest on their own and use advisors, Vanguard found that most investors, and maybe not you, maybe you're just really, really good and you do what you're supposed to do and you rebalance and you have a plan, but most investors tend to fare worse than they would have with an advisor, again, based on some studies they did.
And guess what? The weather is changing. It's getting cooler. The lake is starting to get just a little chillier, so I'm going to come back in and start working again. So if you'd like to have a meeting with me,
until the next vacation.
Well, there's that, which is being worked on as we speak. But if you'd like some help, I'm going to actually start to talk to people again because the summer's over and got to do that. They tell me. You just simply go to talkingrealmoney.com, click on Meet an Advisor, and say, I want to meet with Tom.
Really? That's all there is? That's it? That's all there is to it?
Yeah, Meet an Advisor.
Well, what more do you need to know?
I think that pretty much covers it, but we love all your questions and calls. You can call us on Saturdays. You can call Don with voice questions. You can type in questions for me. We love them. We love taking them.
Go to talkingrealmoney.com or on Saturdays from 3 to 5 Eastern Time. Call 855-935-TALK to talk with us on the radio show.
Yeah,
and
which is fun.
We appreciate you being there, and we hope you'll tell a friend or two about the podcast and keep listening to us as we do one of these almost every day in which we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.